1. Hedging risk components. Hedging of risk components of both financial and non-financial items is allowed if certain criteria are met. Entities can separately hedge the foreign exchange risk, credit risk, or interest rate risk associated with the financial instrument. However, interest rate components that may be hedged are specifically defined by the literature as benchmark interest rates for fixed-rate financial instruments and contractually specified interest rates for variable-rate financial instruments. 2. Hedge effectiveness. To qualify for hedge accounting, the relationship must be highly effective. Ongoing prospective and retrospective assessments of hedge effectiveness are required on a periodic basis, at least quarterly. There is no requirement to separately measure and recognize hedge ineffectiveness. For highly effective cash flow and net investment hedges, the entire change in the fair value of the hedging instrument included in the assessment of hedge effectiveness is recorded in OCI for cash flow hedges, or the CTA section of OCI for net investment hedges, and reclassified to earnings when the hedged item affects earnings or when it becomes probable that the forecasted transaction being hedged in a cash flow hedge will not occur in the required time period. The shortcut method for interest rate swaps hedging recognized debt instruments is permitted. 3. Presentation of changes in the fair value of hedging instruments included in the effectiveness assessment. The entire change in fair value of the hedging instruments included in the assessment of hedge effectiveness is presented in the same income statement line item as the earnings effect of the hedged item.